Bitcoin started the week last week with a promising rebound, climbing 4.7% from the weekly open and briefly retesting its prior all-time high of $109,590. But optimism quickly gave way to risk aversion after the unexpected strike on Iran by Israel on June 13th triggered a sharp sell-off across global markets. Bitcoin retraced much of its early gains with a 7.33% drop, closing the week lower as rising oil prices and macro uncertainty weighed heavily on investor sentiment. This episode underscores how even a strong trend can be swiftly derailed by exogenous shocks, especially when markets are running hot. Beneath the surface, trader behavior revealed mounting stress. Bitcoin's net taker volume plunged to $197 million, its lowest since June 6th. Signaling that sellers had seized control, aggressively offloading BTC at market prices. This selling, however, combined with a spike in liquidations, resembles past capitulation-style setups that often mark local bottoms. If Bitcoin can hold the $102,000 to $103,000 zone, it may suggest that selling pressure is being absorbed and that the market could be primed for recovery, assuming geopolitical risks don't intensify further. Notably, the scale of the correction has been modest, especially compared to the past bull market drawdowns. A 9% peak-to-trough pullback is well within normal volatility bands for Bitcoin, with nearly half of all trading days in the current cycle having seen deeper drawdowns. In addition, the rapid slide in fear and greed index into fear territory, despite a relatively mild decline, suggests market psychology remains fragile. This reflexive fear, however, may actually reduce downside risk as positioning remains cautious and susceptible to quick reversals if demand reasserts. For now, Bitcoin is navigating a classic consolidation within an uptrend, volatile but not broken.